Which ETF is a buy, SPY or VOO, as both of them are the two largest S&P 500 based index ETF funds available. So let's explore some of the facts about them, similarities and differences they have, and at the end, which one is a better option to buy. Hi, my name is Sunny and I make content that affect a common man financially. So let's dive into today's topic, comparing SPY and VOO. If you are new to this channel, please subscribe to it alongside smashing that like button, as that will help me with the YouTube algorithm, which will be highly appreciated. Both SPY and VOO are the two largest S&P 500 index tracking ETFs. The SPY ETF belongs to SPDR, which is an acronym for Standards and Poor's Depository Receipts while trading on the NYSE, whereas VOO ETF is from Vanguard Group, who have practically pioneered and popularized this type of investment product, also listed on the NYSE. Since both of them track the same S&P 500, so practically they have almost similar holdings, but because of different management style, they have different expense ratios. Now, tracking S&P 500 means that their holdings are proportionate to the top 500 largest listed companies that make the S&P index in the US, which are based on their market caps. Any company that has got more market cap will have more weightage in the index, which will be reflected in these ETFs. Since they both track the same S&P 500 index, so naturally they will have identical exposure to the largest 500 public equities in the US, which are subject to, of course, certain eligibility criteria where market cap based weightage is one of them. Both these ETFs, by nature of their holdings, offer a very diversified investment basket for investors, since top 500 of these listed companies are very diverse. The idea about investing in ETF is that you get a balanced exposure in the stock market like mutual funds, reduces your portfolio volatility that comes with single stock investing, and at the end their expense ratio, which is the cost associated to own them, is very nominal as compared to a comparable mutual fund. Since both these ETFs track the same index, so there are not huge differences between the two. But some of the minor differences worth mentioning here are, since they are being backed by two different financial institutions, therefore two different management styles of managing your money. If you compare both ETFs at any given period of time, you will notice the weightage of some of the stocks in their portfolio might be off slightly. The reason being Vanguard and SPDR publish their holdings on different time periods. Another difference being their fund size. Vanguard, who has been the pioneer of ETFs, has a fund size of $856 billion, whereas SPDR SPY has $455 billion under management on the day of recording. Now, the most important is expense ratios, which is 0.03% for VOO from Vanguard, whereas SPY has an expense ratio of 0.09%. Since our returns are based on the growth of the fund minus the expense ratio, which is the cost to run a fund, so there is a chance that your net returns from these ETFs might be off by a few decimal points. We all know US is home to some of the largest corporations in the world, where S&P 500 index tracks up to 500 of them based on their market caps. Therefore, investing in such index fund is always a good idea when you are first starting. Like I said, it gives you a balanced exposure across those top 500 big listed companies that reduces price swings up or down, which often comes with investing in individual stocks. On the flip side, it also means you will not get huge life-changing returns that you can expect from individual stocks. As an example, if you had invested in Tesla a couple of years ago, you might be sitting on 8 to 10x your money, but you cannot expect these returns while investing in these ETFs. The simple reason being Tesla got added onto this index last year, after which big ETFs start buying it because they have to reflect and mirror S&P 500 index. So that means they started investing in Tesla when it was already a $500 billion market cap. Consequently, they missed the huge upside in that stock. In my opinion, investing in individual stock is not for everybody, We all get very excited when we get 8x or 10x our money, but not everybody can digest when the portfolio drops by half. That is where I think ETFs fill in the gap for those investors. But that is me. I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor. Please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.